It is a misnomer in the industry that industrial is just these big factories. Like you just hear FedEx or Amazon, when in reality, there's tons of small businesses. That's really the economic driver of the industry.
If you're a residential real estate agent earning $200,000 a year and you want to grow your passive income, this show's for you. Learn the secrets other agents use and hear from experts in our field in order to guide you along your journey to investing in assets like apartment communities so that you can turn your commissions into cash flow. I'm Randall DeCleared. Let's go, baby. Okay, I had the opportunity to speak with Chad Griffiths today, and it was an amazing conversation. It got me really juiced up to talk about industrial and learn more about it myself. He's a luminary in the industrial space, right? So he's been making waves since 2004. He's been active, and his credentials, he's got, I think, over 500 deals he's done, anywhere from mom and pop up to institutional grade buyers and tenants and that sort of thing. So wealth and knowledge, has a ton of stuff going on there. Not only does he have the brokerage side of it, he also invests himself. And so he knows the product, he knows how to work with buyers, sellers, and transact in that form, but also represents himself. So he's a pretty influential guy in the space. He's got a podcast called The Industrial Real Estate Show, and he talks about some of the guests he's had on, some big names. So you'll hear him talk about that a little bit. He's also just given the moniker of industrial influencer by Globe Street. So check that out as well. We talk about it a little bit and we dive in. It's a really good conversation. Made me, again, want to learn more about the industrial space and get started myself. So before we dive in, before we bring Chad on, just like to remind you all to go and rate and review the show. Helps us a lot. It helps us bring you valuable content and guests just like Chad. And we wouldn't be able to do it without your support. So if you find this episode helpful, by all means, please jump on, just give us a quick review and a rating. So let's jump into the show. And here we go. Chad, welcome to the show. It's awesome to have you on. Thanks for joining me today. I know that you are in industrial and you are, is it the beef capital of Canada? Is in Alberta, the beef capital? Is that where we are?
Yeah, that's actually a good way of describing it. We are renowned for our beef. So very similar to Texas, actually. From Canada's standpoint, Alberta was probably the closest thing to being the equivalent of Texas in Canada. So beef is big. Oil is probably the biggest thing. So we live and die by oil prices. So yeah, it's an interesting market. And thanks first for having me on. Really excited to be here too.
Yeah, for sure. It's good to have you. We're pretty much in the same style of market, I guess, than Texas, oil and cattle. So let's talk some real estate. I know you're in industrial, and I know from talking to you just a minute ago that you're familiar with the U.S. market, but you're based out of Canada. So I'm just kind of curious how the two markets differ, if at all, and if you could speak to that a little bit.
Yeah, a great way to start it off. Yeah, so my background, I'm Canadian, been born and raised in Canada. I've been a broker for roughly 18 years, started building my own portfolio about 10 years ago. Everything that I own is within like 15 minutes of where I'm sitting right now, but I feel I've got enough concentration. Like I'm heavily exposed to this one market in industrial. So I've been actively looking for the last couple of years to go to the US. I really like Texas, probably because it feels already like home, being similar to Alberta. And I like Florida as well. Surprisingly, through all my research, there isn't a whole lot of difference. And I like to break industrial into three categories: warehousing, manufacturing, and flex. And real easy, warehousing are buildings where things are stored. Manufacturing, buildings where things are made, and flex is kind of a miscellaneous catch-all. And we could get into that later. One property that I own is a flex building, and that's a pretty good example because I can share some of the tendencies that I have in there. But manufacturing and warehousing, buildings where things are made, buildings where things are stored. Pretty simple. So that model is very consistent, whether you're looking in Canada, whether you're looking in Texas, whether you're looking in New York, whether you're looking in London. I've talked to people in Australia. I've talked to people in China. I've talked to people all over the world. And that whole underlying premise of a building where things are stored or things are manufactured is actually pretty simple and intuitive. And there's not a whole lot of deviation that goes from one market to another, other than some of the systems internally might be different. Like in your market, you might not need heaters for the warehouse space, probably just a good temperature all year round. If anything, it might get too hot.
Yeah.
Whereas in Canada, because we're cold in the winter, we need a lot of mechanical systems in there. But outside of some of those little nuanced areas, the buildings are all very similar. The tenant demand is all very similar. If a company like FedEx needs to have a 300,000 square foot distribution center, that center is going to look very similar as it would in Dallas, as it would in Chicago, as it would in Toronto. So the amazing part that I like about industrial is that it is very uniform and ubiquitous across all different markets. There's definitely subtle nuances in the market itself and how you need to evaluate deals and just how some industrial parks are designed, but the buildings themselves are very standard across the board.
Yeah. So what do you focus on then? Like for your investments, do you run the gamut? Do you do all of the above, or do you really focus on the flex?
I like the flex personally from a few reasons. So if you look at warehousing, and I was in Dallas not too long ago and we went through Austin, like you look at Tesla's big factory outside of Austin, it's a 10 million square foot building. I don't have the capital to go and buy a 10 million square foot building. That's way out of my realm. Or even a 300,000 square foot building that might be leased to a FedEx. That's also beyond my capacity. So there's companies that can, and a lot of institutional money like real estate investment trusts, they will pursue that. For those reasons, I do like flex. The majority of my portfolio would either be flex or like a light manufacturing. Interestingly, actually, the first industrial property that I bought was a small condo. It was only 400 grand roughly. The last property that we bought was 6.5 million. And we've kind of scaled everything in between. We don't go towards any of those smaller properties anymore. I'd say our wheelhouse, it's a small group of partners and myself, our wheelhouse is probably in that $2 to $6 million range. And yeah, it's going to be light manufacturing or flex properties.
Okay. Is there a reason you moved away from the smaller deals? Obviously, you can deploy more capital into some of these other deals, but is it just less of a headache going bigger?
It's funny you say that actually, because I still own that small one. Had it for 10 years now, or just about 10 years. And I don't think it's a bad thing for investors to consider small properties like that. That one was just my partner and I, we bought it 50-50. We put our own cash into it, got traditional bank lending on it, and still have it. Just a single tenant industrial condo. It's very small. We've probably paid down half the mortgage now. We've cash flowed every month since we've had it. We've had 1 month of vacancy in almost 10 years. I still like those small ones, but for the reasons you mentioned, it's hard to scale. And when you start looking at building a portfolio and you're building systems and you're trying to get everything behind the scenes working in unison, you need to have critical mass to do it. And there's just not enough income that comes off of that. But I think that that's a great spot for someone to dip their toe into it, is if they did want to consider industrial, there's plenty of routes they can go. They can be an LP in a project. They can invest in a REIT. If they did want to have direct ownership, finding someone that has a little bit of experience in the industry, and perhaps you're the capital partner and you buy it 50-50 and you have direct ownership and full control over it, I don't think that's a bad way to go. What it did for my partner and I is that it gave us some credibility that we could buy an asset, stabilize it, get financing, run a consistent operation on it. And it's been almost 10 years now. That track record is invaluable. And I'd like to think that that was instrumental in us acquiring larger assets because we all of a sudden had a track record. So at some point, we'll probably sell that one. It's the smallest property that we own considerably right now, but it has a special place in my heart, that property, just for what it helped us springboard into.
Yeah. So you talked about a few things in there that I want to relate back to. So I've been heavily focused in the multifamily space, and I'm very interested in the industrial side of it, just because some of the new construction, the cost to construct is a lot lower, but the rents are something that I want to kind of pick your brain about in a second. But I wanted to ask you, and you answered it at the end, I guess you also have a unique insight into needing a track record in order to continue, because you are a broker agent yourself, right? So you get an offer from somebody on a piece of property, and if they have no track record, then it's kind of like, oh, well, I'm not going to necessarily send you something. So in the multifamily space, it's very similar. I've been looking at these 150, 250 unit apartment complexes. And if you're not partnered with somebody that has the experience to acquire those or take those things down, then you're kind of spinning your wheels a little bit, I would say. And so, yeah, focusing on some of the smaller entry-level properties in order to get in, get your foot in the door, get the track record, build your resume, that sort of thing is a great place to start. So sounds like that's what you did. And then you guys have just kind of been building from there. So not really a question on all of that, more of a statement. But again, kind of curious now, since you have that track record and you are in a unique position as a broker in the business, when you guys are submitting or looking at properties, what kind of difference do you have now? Like, are you having brokers reaching out to you saying, hey, we have this deal that's coming up, or even owners that are reaching out to you directly saying, hey, we have this thing, you guys want to take it down? Has that shifted?
It has, yeah. And it's like anything, even being brokers, right? You start off at the beginning and you have no track record. People don't trust you. But as you start building credibility and you've developed a pipeline, then absolutely. And we do have that now. We get presented with deals that we wouldn't have seen 5 years ago. And I think that helps. As an investor, you really just want to look at as many deals as you possibly can. And out of 100 that you get, maybe you eliminate 90 of them quickly. And then of the remaining 10, perhaps you do a little bit more analysis, and then maybe you write on 5 and close on 1 kind of thing. But it's very difficult to close on that one property if you're not looking at a whole bunch first. So yeah, it has shifted over the last few years on that.
Yeah. So I want to talk to you a little bit about understanding the industrial side as well. But before we jump into that, I mentioned a buddy of mine does this out of Houston and buying Atlanta, doing a bunch of stuff in the industrial space. But I don't know the acronym for it. It's like IAS or something where it's open, kind of like a lay down yard, but it's still zoned industrial. IOS. Okay. What does it stand for?
Industrial outdoor storage.
Yeah.
It's funny because that term came out of nowhere, and it's always existed. Like, it's really just refers to any industrial zoned yard area where they can use it for all sorts of things. It can be truck storage, which is very common. It can be used pipe laydown yard. It can just be used for equipment storage. There's actually a lot of uses for it. And this goes back several decades, not centuries, of people storing product on industrial land. Yeah. But somewhere in the last year or two, someone, and I'd love to find out who it was because it's brilliant branding. They gave it the acronym iOS. Yeah. And maybe it was just so that it could have some more institutional appeal, because industrial yard doesn't sound sexy, but all of a sudden iOS sounds pretty appealing.
Ooh, nice.
So that nothing's changed other than someone gave it a label, and it's brilliant marketing.
Yeah. Do you invest in any of that?
I haven't, no. But the more that I've followed it over the last couple of years, the more I'm intrigued by it as well, because your capital costs are very low. Yeah. You're not putting a building up. You probably have to do some basic site work, like gravel the yard, probably have to fence it, maybe put some lighting, but generally you're not even having to pull utilities to it. So it's very easy to develop that. And if you can get a good tenant in there, your costs and your maintenance and management of that, it's very, very low. So yeah, I've become more intrigued by it as of late too.
Yeah. The tenant base, to me, it was a question mark. I had a guy come and present a deal to me here in San Antonio, and he had land, and right next door, somebody had all these trucks there. And he was like, let's just buy it, and then we'll have the truckers come and they'll park the trucks. I was like, okay, where are you finding the truckers? Like, where is that tenant base? Is it a single company that is like a dispatch yard that's putting all the trucks? So that's where I got hung up on that deal. Just didn't know where you would find those guys, if it was a single company or if it was like I had to go out and start knocking on truckers' doors at truck stops and be like, hey man, you need a spot. Like, what does that look like?
I think that actually highlights why industrial can be a good investment. And in that particular case, the risks that come with it. So the portfolio that we have, it's all buildings and it's all leased to companies. And in the most case, they're leased for 3 to 5 years and sometimes even longer. I like that profile of having consistent and reliable income. So from that standpoint, I lean more towards that debenture type of investing where you're making your investment, you know you're going to have cash flow. That buying land where there isn't a tenant, that's more on the speculative development side. Definitely value add. If you can buy that site, rent it for a few years to truckers, and then turn it into a development, there's huge value add potential on that.
Yeah.
But to buy a property, specifically land where you don't have a tenant in place, that's pretty speculative to me. So that's probably why in hindsight, I haven't pursued it before. I would be more on the side if you could find some land and you had a tenant in tow. So you already knew someone, but I would personally have zero interest in renting individual, call it 100-foot spots to truckers. Like that is of zero interest to me.
It didn't sound like a win. I think they were making money on the one next door, but yeah, it's one of those challenging tenant base, I would think. All right. Well, in doing some research, I was looking into it. Looked like you have completed over 500 deals from clients, like small companies to institutional size. So I'm kind of curious on that front. Like, what is the difference or some kind of insight that you have on dealing with those two different types of clientele from the smaller to institutional size?
It is a misnomer in the industry that industrial is just these big factories. Like you just hear FedEx or Amazon, when in reality, there's tons of small businesses. That's really the economic driver of the industry. So I think what it's helped me with is get an understanding of how a small mom and pop shop will look at a 2,000 square foot small warehouse bay, all the way to how these big institutional funds make their decisions. And the big institutional funds, by the most part, they're driven by yield. It's just a return. Every decision that they make, we're going to buy this property. How can we pro forma this income out 10 years? What are all the assumptions that we have to make down the road? And then calculate their internal rate of return. Here's our yield. Here's what we anticipate. All the management decisions come down to maximizing the return. Small businesses, on the other hand, they're more considerate about just finding the optimal space for their business, and not as much of a emphasis on a return as it is just finding the best place that works for them. And then there's everything in between. Like you will find smaller investors, and I'd fit in this category where I'm driven by yield. I'd follow that mantra of institutional investor that I try to do the same thing as well. I'm just driven by yield. How can I find the best return on my money for the next 10 years? Whereas there'll be other investors that are just trying to scale. They'll say, we just want to add property. So we want to get to 10 million square feet in the next 10 years, and we'll just buy everything that we can possibly get financed. So it's a full spectrum, that I'd say. And I think that just highlights the importance in anything. Industrial is unique in that regard, though, compared to like a multifamily property, where there are so many different variables that go into it, and the tenant profile can be so different. Where you're buying a multifamily property and you buy 100 units, all those tenants are going to be somewhat similar, right? Like there's not going to be like crazy deviations. Whereas in industrial, you could be dealing with one tenant that's a mom and pop shop all the way up to a Fortune 500 company that's very elaborate and intricate on how complex their system is. You do just deal with so many different people. Whereas in most other sectors, multifamily being one, your tenant profile is pretty consistent across the board.
Yeah, that is unique. And that kind of like retail, almost you could have similar tenant mix in a retail space compared to multifamily. So I want to talk about the returns in a second, because you just mentioned it, and it definitely is something that piques my interest on typical return profiles. But before we do that, I think it's important to really hone back in on the flex that you focus on, just so that listeners understand like what that means. Because is that like a roll-up door on one side with a little office on the other, and somebody's in there selling promo products, or it's an AC company, or like, what does the tenant mix look like, and what is the product, so that we can talk returns about that specific product in a second?
Yeah, and I'll use that one building that I have in my portfolio as a perfect example. So I generally describe flex as any property zoned industrial that isn't used for manufacturing or warehousing. It's not to say that it can't. You might find a flex property that has a manufacturing tenant in there, but more often than not, you're going to have unique uses in there. And I'll give you an example with this building. So it's a 23,000 square foot building. It's industrial zoned. It's in an industrial park, but it happens to be on a somewhat major road in the city. So some of our tenants in there, we have one tenant that's straight office space. So this is an industrial building. There are overhead doors, like you mentioned in there, or roll-up doors, I think is more common terminology in Texas. So roll-up doors or overhead doors in part of it. We have one tenant, straight office space. Next to them is a cabinet store. So they basically just have it as a light showroom space. We have an equestrian store in there that sells horse products for horse riders and enthusiasts. We have a hot tub manufacturer and showroom in there. We just put a flower shop in there last year, and we had one small vacancy remaining. We just leased out to a furniture store. So this is an industrial zone building. It's an industrial building for all intents and purposes, but that's a wide and unique tenant mix that you wouldn't find in many other buildings anywhere. You're not going to find that in a retail building, because you're not going to be able to accommodate some of that light industrial work. Like the hot tub manufacturer, they've got overhead doors in it where they're sending and receiving hot tubs all the time.
Yeah.
So I think that's a pretty good example of what a flex property is. And why I lean more towards that flex property is that ability to have so many different types of tenants in there, that someone's always going to want to have exposure to a main road. Our rents are much cheaper than retail. So we can attract companies that want to save a little bit of money, but still have the benefit of having main road exposure, save on their rents. And in some cases, there's the ability to have a roll-up door in some of these bays. So I think that's a pretty good example, but I've seen so many different types of uses: churches, bottle depots, art galleries, especially in buildings that are in the downtown vicinity that perhaps there's like an old industrial building, but it has that exposed brick feel. Those make perfect art galleries. So you name it, you could probably put it in a flex building.
Yeah. We got married in a place just like that. It's called a brick. And it's like the new warehouse. Makes you think of something like New York style that has been converted to lofts or something like that, But yeah, that's a cool space. So in that, again, you talk about equestrian. So is it like they have a showroom and they have a warehouse space, or is it all warehouse?
Yeah.
And they just, okay.
They're in about 4,500 square feet.
Yeah.
And I would say 3,500 of it is showroom retail space. And then 1,000 of it is a separated warehouse space where they just have inventory in their roll-up door.
Yeah.
Works perfectly for them. It'd be very difficult for them to actually put that into a retail space.
So do you guys have to go in and do TIs to build out their TIs or tenant improvements if you're listening? So are you building out their showroom, or are they going in and spending the money to build it out?
It's usually some combination of both. But the one thing that's great about industrial is that you're not very often having to put a ton of TIs into it, especially in that flex or class B light manufacturing space. It's often just cosmetic, and it's a mix. It all depends on the deal factors. So if you're getting a certain rent, you're probably more willing to contribute some money into TIs. If they're rate sensitive, then you might want to push for them to do more of the TIs on their own expense. Or it could be some split where you just provide them an allowance and they build it out, and anything over they put in. There's really the full spectrum, and it's just a deal variable.
Okay.
So if they want more TIs, then the rate's probably going to go up, and vice versa.
Got it. Okay. Yeah. Underwriting for that would be something I would have to dig into a little bit to understand that a little bit better. And you were talking a minute ago about, now that we have, that's kind of like, is that your bread and butter? Is that your home run? It's your fastball that you're swinging at, or is that?
It's probably my favorite project, and I own that with 3 other partners. We put in well over $1.5 million into that property recently. So we did some significant upgrades for the office tenant in there. We did a full exterior renovation. So we took it from like a building that almost looked like an old woman's prison to now just being this really cool building, which probably biased, but I think it's the nicest building in the area. So that's probably my favorite. We probably overspent on this one in retrospect. So I might have to own this for 30 years and pass it to my kids and let them earn a return. But it's probably my favorite just in terms of how cool it turned out. We have a few other properties that have probably outperformed, but it's that very boring industrial property that's hard to get someone excited about it beyond the fact that it's had good returns. Whereas this one, I've had so many comments on it, on how great it's turned out, that it's almost like a trophy asset, right? Where you own it even though it doesn't earn a return.
Yeah. First thing I clued in on, I was like, is that like a loss leader? Essentially, you just did it. So now people talk to you about it. And even though you may not be getting the high returns that you want, you're still kind of cements you in the community for the guy that does this type of product.
Well, everybody in the industry would know about it because it's on a prominent road and it was a significant cosmetic upgrade. So I like the way of describing it as a loss leader, like a grocery store selling milk at cost just to get people into the grocery store.
Yeah.
That's a really good way to look at it.
Yeah. I consider that sometimes too. So I run a small little mastermind of apartment investors, and we were like, okay, there's a lot of headwinds right now in the multifamily space. Is it worth buying something now just to get people in and show them the types of returns, how we manage something, even though we're not going to really be making any money? So I think about that sometimes. And so I didn't know if you consciously did that going into it, or if that just was a byproduct of, I guess in the single family space, you could be like, you put the nicest tile in, even though it's not going to sell for more. It's like, so was there a conscious decision, I guess, going into it saying, we're just going to make this thing, we're going to blow it out, it's going to look awesome, people are going to talk about it, or let's just do it? Which way was it, I guess? Yeah,
the practical side of me would say that every decision that I make is to maximize yield. But the actual side of me was that we just bit off more than we can chew. And not from a financial standpoint, but from a return standpoint, where we went overboard. We went overboard on some of the renovations we did for the inside tenants. We went way overboard on the exterior. I'll share a picture with you later, actually, on just how big the transformation from a woman's prison to like a really modern building looked. We just went overboard. And it's one of those things too, where I'm sure you've realized this as well, is that you always overspend and it always takes longer than you expect.
For sure.
And the more complex the project is, the more that's exacerbated. So, and that was exactly the case that we had here. Is we went into it with a budget. We went into it saying, if we can hit these numbers, if we can get the rate returns that we want or get the leases that we want, then we'll have the returns. And we just spent way too much money. So that's just all it came down to is when you're faced with that task of, do you build exactly what you want and accept mediocre returns, or do you skimp on some of this stuff and perhaps regret it in 5 years? We just decided that we were going to commit to it. So we have to renew our mortgage on this actually next year. And I'm guessing that when we renew 150, 200 basis points higher than our current loan, it'll probably wipe out a good chunk of our cash flow. But if we can hold this thing for 20 years, this is a long-term play for all of us, unless something catches us by a curveball. Hopefully in second 10 years, our decision to make this a kind of that trophy asset pays off. But right now, it's definitely more ego than sensibility that we put into this one.
Yeah. I will say this because my background, again, is rehabbing and fixing and flipping houses, a lot of them. And anytime that I did a house and I skimped on something here or there, it translated in the price, or it was harder to sell, whatever. It was harder to manage. If I kept it, there would be headaches down the line. So there's absolutely something to be said, especially if it's a long-term play, to just spending the money, making it the right way the first time. And so knowing that going forward, though, have you guys changed your remodel process or changed how you look at assets going forward?
Yeah, I still am just driven by yield.
Yeah.
So that one was a unique one for sure. Going forward, it's a similar pro forma that I think most investors are going to run. What's our income projected to be over the next 5 to 10 years? What assumptions do we have to make in vacancies and TIs and the things that you have to spend? And then what's our return on it? I would say that I'm much more driven as just a yield buyer than anything.
Yeah.
And I think that speaks to one of the big risks with industrial. So I'm naturally a big proponent of industrial. And it's funny, it might be odd to even hear me say this. I think industrial should actually scare most people because it's the only asset class where you do run the risk of having to spend a significant amount of money to get the next tenant. And a good example of that is a building in our market used to be used for fiberglass manufacturing. So it was custom built with a bunch of interesting things in there, like sub basements for the filament. I don't even understand exactly how it went, but it was a very wonky building. And when that fiberglass manufacturer left, they had to spend a considerable amount of money retrofitting it to make it standardized for the average industrial user. So I think that that's a huge risk where someone could go in and let's say that building came on the market. And let's say that that tenant had 5 years left on their lease. So an investor might say, okay, well, this is great. I've got a building that was specifically made for them. They're obviously invested in this. They're not going to leave because it works so great for them. And I'll renew them for another 5 years. And let's say they buy that on a 5-year cash flow. And then after 5 years, the company just shuts down, which they did in this case. Glass manufacturer just left. So now you're stuck with a building that you have zero cash flow in. It's about an 80,000 square foot building, single tenant in there. And if that tenant leaves, I'm guessing that was probably $1 million plus retrofit to get that standardized for the next tenants. How many people would have gone through that exercise of saying, I'm going to have $1 million CapEx expense in year 5?
No.
There's not many people that go through that exercise.
Yeah.
So that's where industrial can actually be scary. I think the more experience you have and the more knowledge you have and the more you're prepared to identify those types of areas, then a sophisticated investor will go in and say, well, if these guys go out of business or if they don't renew in 5 years and it costs me $1 million to rectify all these issues, I need to pay $1 million less. That's how I would approach that now. It's hard to do that if you don't fully understand what's an industrial building, how is it compatible for the next tenant that's going in there. That's why there is a learning curve. It's not for the faint of heart, and it can destroy someone that just isn't prepared to deal with that.
Yeah. We're proud to be sponsored by Ridgeline Investment Group. Ridgeline has a track record of transacting more than $53 million in assets throughout Texas. Ridgeline is currently looking to acquire 100 to 200 unit Class B multifamily communities between 5 and 20 million in San Antonio, Temple, Waco, Tyler, and other Texas secondary markets. To learn more about Ridgeline Investment Group, visit www.ridgelineig.com. So you have mentioned the importance of understanding what a building is worth if it were vacant. I heard you talking about that. Taking that into account and underwriting this deal specifically. And then I come to you and I say, hey, here's an offer. It's $1 million less because of X, Y, and Z. How realistic in a given market is that offer going to be taken seriously? Because Joe Blow down the street may not take that into account. So obviously I may lose that deal or not win that deal, but I guess it's just throwing offers out and seeing if it's taken seriously or not. But what would you say from your experience would happen if I came to you with that type of offer, $1 million less than asked because of X, Y, and Z? Hypothetical.
Yeah.
Right.
Well, I really do think it's the difference between smart money and dumb money. There's a ton of dumb money out there, or at least there was leading up to interest rates increasing last year. There was a ton of dumb money. So there might have been someone that went and said, yeah, I can see this being worth $10 million. I have a company in there for 5 years and I'll get cash flow for 5 years and then they'll renew because this building works for them. That's dumb money in my mind. Smart money would be you saying, what is this property worth vacant? Because every tenant will eventually leave. I have absolute conviction of that, is that every tenant will leave eventually. They could stay in there for 50 years. They could go bankrupt. There could be something that was behind the scenes that nobody was expecting. That company could go bankrupt tomorrow. So anywhere from 1 year to 50 years, that tenant can be in there, but they will eventually leave. So the smart money goes and says, what is this building worth vacant? And if you determine it's $1 million off and you said, I'll offer $9 million for this property, and here's why, it's up to the seller to determine if they see that rationale or if they want to wait until someone comes along that doesn't notice that. And the industrial, unlike any other asset class, there's a ton of asymmetries in information where some people will have knowledge that other people don't have. Some people will go through that exercise and say, wait a second, this building really only works for this very specific use. And if they leave or they go bankrupt or something happens, I'm going to have to spend all this money fixing these issues. That's smart money. And that's that asymmetry of information. That's one of the reasons that I really like industrial, is that if you are prepared and knowledgeable and you can really flush those things out, then you're exploiting opportunities that other people didn't even know about or didn't even consider. And it can work the other way too. It can work where there's a building that's underperforming and someone with the knowledge can say, I think I can come in, I can repurpose this. And perhaps it's a flex building that was used by a manufacturing space. And someone creative and prudent can go in and say, wait a second, if I actually repurpose this building as more of a flex building and improve the exterior of it to make it better curb appeal, and I attract a different type of tenant, if I move this from being a machine shop to being a flower store, maybe that's a bad example because it's, I don't know if a flower store could take as much space, but just using that example,
sure,
the flower store is probably going to be willing to pay more just for that retail feel and retail exposure than the manufacturing company would. So it can work both ways. I just would never want it to work the opposite way, because you imagine that scenario where you work your entire career, you buy that one building, tenant leaves for whatever reason, and you just wiped $1 million off your portfolio value. Well, that can be devastating. It can unravel 10 years worth of work. So I think that's the biggest thing that I'd say about industrial real estate, is that be smart money, don't be the dumb money. And to be that smart money, it's a bigger learning curve. There's not a course or a textbook and someone can go into and say, this is everything you need to know about industrial real estate. It is a learning curve, and it can take a lot of time before someone gets up to speed. But even though it's not easy, it still presents itself with a lot of opportunity.
Yeah, I want to push people to, obviously you've got a podcast going on, so we'll talk about that in just one sec. But before we do, I want to talk to you about the return profile, because again, I see a lot of opportunities that come across my desk on the multifamily space. And I understand that asset class. I understand the typical returns that people are pushing out, double your money in 5 years. At least that's kind of what was happening in the last 2018 and on, and maybe even 2 years, 3 years. But typical return profile on a multifamily and how those deals are structured, with if it's a syndication or a fund. So I'm just kind of curious, what is a typical return profile, either on an IRR basis, or like, what are you tracking? What are you looking at in the time horizon on those types of deals? If I were an investor, I guess even before that, when you're doing your deals, are you guys syndicating? Are you guys just doing joint ventures? How do you guys buying your stuff right now?
Yeah, we've been JVs.
Okay.
Until now, I haven't raised any money myself. So it's been all JVs. It's interesting. I've actually looked at this pretty extensively. The returns are very comparable. In fact, multifamily in good years might even outperform industrial. So it's not that industrial, you're going to go and hit it out of the park and get 30% IRRs. I would say if you're in that 12 to 15% IRR range, I think that's a very good return from my standpoint. I like the stability element of it, where there's a few things that I'd actually say in support of industrial and a few reasons that I'd say it's not worth it. So I'm trying to take a very balanced approach because I'm the antithesis of a salesman for industrial. In fact, I tell a lot of people to stay away from industrial for the reasons that we mentioned. The returns are comparable. Where I think multifamily wins is that it's much more familiar for people. If they own 10 houses and they decided they wanted to sell those and buy a 50-unit apartment building, it takes work. There's things that they would definitely need to learn, but it's not a quantum leap, right? They already understand the tenant profile. They've got to understand a few more things about purchasing a building of that size, but it's not a big stretch. If they own 10 houses and they decided they wanted to go and buy a $4 million, $5 million industrial property, that is a quantum leap. There is so much more information that they need to have so that they can avoid making a mistake that in most cases, it's just not worth it. It's just not advisable for most people to consider industrial. Where I do like industrial though, is we're renting to corporations. So we're not renting to individual people. We're not beholden to any residential tenancy acts. If you have to evict someone, not even withstanding the emotional toll of having to evict someone over Christmas, as an example. If it's a company, I have no remorse. If the company doesn't pay their bills, it's followed by its contract law for the most place. We don't have moratoriums. We don't have rent control. We don't have governments trying to interfere in that relationship in tumultuous times. It's contract law. And the contracts are often favored that any distress situation where the tenant's not paying their rent can be handled much easier and quicker than on the residential side. And you also just have the comfort of knowing you can see their financial statements. So if it's a company that you're renting to, well, what is their income? What's their expenses? What do they have in retained earnings? There's so much more in depth that you can go to get a sense that they're going to be able to pay their rent. And it's dealing on longer term leases where residential is often 6 months to a year, give or take. Maybe you have some longer, maybe some shorter. In industrial, we can have 5, 10, 15-year leases. So I think that all allows industrial to scale easier. An example that I love to use is one property in our portfolio is a roughly $3 million building, single tenant, light manufacturing building, leased to a Fortune 1000 tenant. So very large company, a single tenant. They've been in there for 5 years. That's very steady cash flow. And I've probably been to that property once in the last 2 years. Whereas if you had $3 million to put into a multifamily space, and maybe the equivalent to that is a 20-unit building, how much more management is required to manage a 20-unit apartment building versus a single tenant industrial building where they take care of everything on their own? A light bulb burns out, they change it. Toilet gets clogged, they call it plumber. Versus that 20-unit multifamily property, that's where I think industrial has an advantage, is that ability to scale without having a whole lot of infrastructure in place. And our portfolio has gone to a reasonable size. We have a property manager that looks after a couple of them. Everything else we do internally. So we've been able to scale to a pretty good sized portfolio without needing a considerable amount of infrastructure to manage it. So that's a long-winded way of getting to your question, is that returns are very comparable. I think if you were to take returns over a long enough period of time, even going back 20 years on what two investors, one bought a $10 million apartment building, one bought a $10 million industrial building, I think that those returns would actually be fairly comparable over that period. But there's pros and cons to it. The pro that I like is that asymmetry of information. If you're an expert in the field, you can find opportunities easier. Multifamily, there's so many multifamily investors, right? If a property comes available, there's, 50, 100 different guys that could all look at it and try to make sense of it. In industrial, there might be a couple. So that's a roundabout way of saying the returns are very similar, but it's a completely different process of building a portfolio and managing it and operating it.
Yeah, you've sold me, man. I'm like, shiny object. It's like, honestly, it is one of those things, and you nailed it on the tenant profile. The amount of, in your example, 20 units, you've got 20 leases per year you have to renew at a minimum. My question again on that front would be, how much risk do you have with that single tenant in that $3 million property, and how do you mitigate that? And so a couple of things. Curious what your response is to the risk, I guess, for that single tenant. Like, how do you mitigate that? Because I know you talk a lot about leases on your show. and understanding leases. And you already alluded to it a minute ago with the fiberglass company that was in there. So like, what is the response to having the single tenant lease risk compared to 20 units that I can, if one tenant leaves, then I don't have my entire property vacant, on a multifamily?
Short answer is considerably more risk. That's another strike against industrial. Is you're right. If that one tenant went bankrupt, and it can happen. We've seen large companies go bankrupt before, and they stopped paying their rent. We went from having income on 100% of the building, having 0% income, whereas you're never going to lose 20 tenants all at once. It'll never happen. So huge strike against industrial.
So do you have a lineup of like, how often do you look at that building and say, if it hit the fan today, this guy left, like we have 3 people we could reach out to who are looking for space? Or is that just being in the business, you always know kind of people are looking for leases and you could maybe backfill that pretty quickly?
Yeah, it comes down to understanding the market and just being on top of it. So that's where I think still being an active broker is helpful, is that I just know what deals are happening. We went through this process and we said that is, what is this property worth if it went vacant? The tenant doesn't renew or something worse happens. So we know that what that property, how it would be positioned in the market, and it changes. Like there might be stronger demand at any one period of time, or if we go into some sort of recessionary period here, maybe there's less, but we still have a very good understanding of what that property is worth. Maybe we sell it. Maybe we have to find another tenant. The one thing that I'd say that is the best, not best, it's a note in Italian industrial's favor is that quite often we have a minimum of 6 months to know that the tenant isn't renewing. Like bankruptcies aren't all that common, actually. They happen. So I don't ever want to discount that as a potential factor, but it's actually rare. In my entire portfolio over the last 10 years, we haven't had one single company go bankrupt. So could happen tomorrow, knock on wood, but it's not that common. What mostly happens is you get notice that the tenant isn't going to renew. And most leases are going to be structured that if they do have an option to renew, they need to exercise that 6 months before the lease is coming up. And the great part about that is that gives you a 6-month runway to try and backfill it with another tenant. Yeah. Whereas you generally don't have that ability in multifamily because it's month to month.
Yeah, you're kind of just always marketing for a tenant. Always
marketing for a tenant.
Yeah.
So in this case, we'd have 6 months to find a tenant. And this did actually happen in one of the property that we had, single tenant space. Tenant was going to leave. We ended up selling it at a little bit of a discount, but it still made sense. Looking back on the numbers kind of as a post-mortem audit, we still actually did okay on the investment, but we had 6 months. It's 6 months to try and find another tenant or sell it. So when you've got that much of a runway, it's a bit of a cushion, but I certainly wouldn't state that as a benefit versus having spread out tenancies and reducing your risk. So again, I am a fanboy of industrial, but I'm not a fanboy of saying that everybody should do it, because that is a strike against it. That'd be check one up for multifamily on that.
Yeah. So I guess I want to ask you then specifically for myself. I know some of the guys that have been focused on multifamily heavily have kind of shifted just because of the headwinds in the multifamily space, the difficulty with getting debt, a number of these things. And so I'm looking for maybe doing some kind of small development, like warehouse development, either development or buying. I give an example. There's a roll-up door. There's an office space, 600-700 square feet each side, something like that, maybe 8 to 10 units in a strip, and then doing maybe 24 on a single parcel, and then having air conditioning guys, so what's your advice? Is that a good type of property to go after to develop? I mean, the cost to construct is a lot lower than, again, putting up a townhouse project that we, have looked at doing. So what's your advice there? You're the industrial guru, man. Let's say here in Texas.
Yeah. And while I have never really been appealed to multifamily, I understand why a lot of investors do it. However, like you mentioned, there's some headwinds happening there. They're about to deliver the most amount of inventory that's ever been produced. Yeah. You've got downward pressure on rent rates in many markets. There's a huge upward pressure on expenses. Are we running into a recessionary period where tenants are going to be that much more sensitive to incremental increases in rent? I'd be much less interested in multifamily than I would have been, call it 10 years ago, just for those factors. That being said, you could still have a very good runway, and yourself and others have done very, very well in that space. And I'm sure that you're still bullish on the long-term outlook of it. On that short to medium, I'd be a little worried. That's not to say that I'm not worried about industrial either. I think that anytime you have these economic factors at play, it'll impact everything across the board. Going back to that one end of the spectrum, if you look at investment opportunities on that spectrum, on one end, you've got a building with FedEx in there and it's leased for 20 years and the rent is consistent for the next 20 years, that's as stable of an asset as I think you could get outside of perhaps a T-bill. On the other end of the spectrum would be a ground up development where you're taking all of the risks of development issues. You've got to secure the land. You've got to go through that entire process. You've got to find an end user for it. You've got to go through all the choppiness over a 24 to 36 month cycle between sourcing the land, getting your development permits, building it, finding tenants, having an exit strategy. There's so much that can go right and wrong in that 36-month process. I don't have the risk profile of doing that ground up development for those reasons.
Yeah.
I'm somewhere more towards wanting stabilized income, but I'm not all the way there because then you know what your return is going to be. There's very little upside beyond what they're paying your rent and how you pro forma. I kind of like the ability to add value to some extent. And that might be a 5-tenant building where perhaps one tenant's going to be leaving at some point down the road. And I know if I fix up their space, make it more attractive, try to reposition it a bit, I can still add some value on there. But I definitely like having cash flow to support debt, especially right now where debt's getting more expensive and that needs to be factored in. There's so many people that have become very wealthy by doing that ground up development. And so long as you've got a game plan on what your exit strategy looks like and what happens worst case scenario, then I think you just go into it with that comfort knowing that you've budgeted for that or you have a plan. Maybe it's renting them out if they don't sell, or maybe it's selling if they don't rent, but having some plan in place. That's how I would approach it. But again, my risk profile is I like having cash flow day one.
Makes sense. Yeah, I agree. I mean, we had a 14-unit development that we got fully entitled, and it was a townhouse project. It was just going through that whole process and the timeline that it took. There's a lot more risk associated with doing those sorts of deals and buying something that's stabilized already or needs some value add, but mostly stabilized. So I second that for sure.
Okay.
So I know that you are the host of the Industrial Real Estate Show. It's a very cool show. You guys should check it out. And so I know you've undoubtedly heard a lot of stories and learned a lot from your guests. So what are some standout lessons that you've gained from hosting that podcast?
Yeah, that's a great question. It's funny because I've interviewed everybody from a brand new broker just to get his story on what it was like, all the way up to Walt Rakovich, who was the former CEO of Prologis, Fortune 500 company. Yeah. And he was gracious enough to spend an hour with me. I think what stands out the most is that there's some really awesome people out there. Bob Knackel's another example, a top performing broker, arguably the most successful broker in the world, I think he's sold $20 billion worth of real estate. I think it was $21.5 billion. Like, this guy is an absolute powerhouse. And he took an hour of time with me and it was awesome. It was just such a great conversation to hear his story. I never felt rushed. I never felt like he had to make it to another meeting. And I think that that's what's really stood out for me as opposed to any specific action item, is that there's a lot of great people out there. And there's also a lot of terrible people out there. And as a podcast host and as a broker and as an investor myself, I get so much energy and enthusiasm talking to great people. And I find it so draining now in comparison when you meet someone that's not a good person, that I just try to cut those people out of my life altogether, because there are so many great people out there that I think that it takes work. You've got to find them. They're not just going to show up at the door. This CEO of a Fortune 500 company is not going to call me and talk to me for an hour without me taking that initiative. And this applies for everything that I look at now. Is what I try to instill in my kids is that take the effort, take the initiative, put the work in, and find those great people, as opposed to some of the, and I know people like this, who have that negative, skeptical look on life that everyone's out to screw them and there's nothing good and everyone's a crook. Well, possibly. I've met a lot of those people too. But if you look a little bit harder, turn over a few more rocks, I'm shocked at how many great people I've had the fortune to interview now.
That's great. Yeah, I second that with having, I get to have this conversation with you. It's awesome to all the people that I've had the ability to meet that I otherwise wouldn't have conversations with from around the world. So you've also been named recently as an industrial influencer. Is it by Globe Street?
Yeah.
Globe Street. Yeah.
Yeah, that's actually a great magazine too.
Yeah. How has that recognition influenced your work or perspective on the industrial real estate investing space?
Yeah, I think it's interestingly, and you might have found this too if you were just kind of peeking around looking at industrial real estate, there's not a lot of resources out there. And when I started 18 years ago, there was almost nothing. Like, it was one of those things where you just went and tried to learn it on your own. and there's very little resources. It's changed to some extent, but there's still very little out there. So when I started creating content on this topic in 2020, I was like a lone ranger essentially. And I just committed to providing as much value as I could. That's been my overarching mandate for the last 2 years and change is I don't sell anything. In fact, I don't mention what city I live in. If it wasn't for my Canadian accent, I wouldn't even say that I lived in Canada. I don't mention what company I work for. I literally have nothing to sell. My whole intent with it is if I can provide as much value as I can to the audience with no agenda, no commercial, just try and provide value, then hopefully you could grow a community. And then at some point, I think you have options that get opened. And you and I were joking about this earlier. I'm like the Joker, the Batman. I'm like a dog chasing a car. I don't know what I'll do if I catch the car. My whole idea right now is just provide as much information, as much value. I've been very fortunate in my career. I've had a great career as a broker. I've been able to build a portfolio. If I can share that knowledge and help someone else out that hasn't benefited from it, that's kind of my objective. And in doing so, what's been very cool, and it's probably part and parcel with the industrial influence and whatever that entails, is that I've had numerous people reach out to me from all over the world just saying, your podcast has really helped me, or that video that you did taught me something I didn't know. That to me is currency. That feels so good getting all those comments. I've been fortunate that, especially over the last year, I've noticed I get more and more of those. So yeah, it's kind of cool.
Yeah.
I set out trying to do this with just adding value. And of course, if we can grow it and develop more of a community, that's great too.
Yeah. Well, you have done that today. I got a lot out of it, and I'm sure everyone else did as well. It was great catching up, great chatting with you. I really appreciate you jumping on, spending an hour with me talking industrial. If you guys want to check out Chad, check it in the show notes. We're going to link to his podcast, and that's a great resource that you can go to and actually start learning more about industrial space. As you just heard him talk about, he is adding a ton of value right there. So if they want to reach out to you, we can throw your contact information down there as well. So thanks again. It's good catching up.
That was awesome, Randall. Thanks so much for having me on the show.
All right. See you on the next episode.
Surprisingly, most of the agents we speak with got into real estate hoping to gain passive income and become work optional. However, only 1 in 5 ever start investing. Most are simply too afraid to start. Once you get educated by listening to this show, you'll be able to overcome that fear and become the 1 in 5 who are finding financial freedom. Don't miss a single episode. If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. And we'll catch you on the next episode.